Welcome to Greenspring, where Greenspring Advisor CEO Pat Collins and me, Marcus Schaefer, our Director of Growth, are talking about all the research and evidence we look into important decisions to make sure that you're making a choice based upon evidence, not market noise, not something built for clicks, as opposed to something built for a great decision. And today we're going to be talking about the recent market volatility. With us will be Justin Brown, Greenspring Advisors Director of Investments. Justin is an awesome resource here. He heads our investment committee, and he's helping with our centralized trading and investments, what we do every single day to put our clients in the best position for financial success. So I guess with that, let's maybe just, Justin, why are we here today talking about market volatility?
Thanks, Marcus and Pat. It's good to be here. So that's a great question. Obviously, I think there's a lot in motion, a lot of news to keep up with. So just to oversimplify, I think we're seeing an increased uncertainty in markets right now. A lot of it is stemming from tariffs. So not only what is in place already, but kind of what is going to be in place longer term. What will those economic expectations and impact be? So we saw a little bit of this in Q1, I think some increased volatility in markets. And then this really became elevated in investment markets after April 2nd, when President Trump had Liberation Day and announced sort of the additional tariffs that were going to be in place. So there's a lot there to discuss. And we've done an hour-long webinar on tariffs, the impact on investment markets. It's called Investing During the Current Webinar. I think that's on our YouTube channel. You can also reach out, and we're happy to help link you to that file. But that's really what's driving markets right now. And really, just to summarize what we talked about there for the scope of this discussion, is tariffs boil down to a few key points. One, they're essentially a tax that are imposed by the government on any imported goods or services from other countries. They're kind of designed to make products more expensive, so it will encourage consumers in the US and businesses to buy domestically produced goods. So that's kind of like one of the goals. And one kind of key distinction is they're actually paid by the importer. So the US company is actually who's paying for that good to be imported. But what the actual cost ends up being, and if you tune into the webinar, you'll kind of see a more detailed breakdown of this, but that cost gets spread out between the producer, the importer, and the US consumer. So that's kind of part of what the market is trying to digest right now. And the last thing I'll say specifically on tariffs, just to set the discussion, is there's really three reasons why a government will use tariffs. And we like to think of it here as the 3 R's behind tariffs. So one is revenues. Essentially, this is helping to bring in revenue to the US government without having to directly raise taxes on US consumers. 2 is restriction. So this is, if they might not necessarily want additional revenue, but they want to restrict imports to help protect US and domestic based businesses. That's one reason. And the last is reciprocity. And I think if you sort of tuned into the Liberation Day announcements and some of the messaging, I think a lot of it was around reciprocity. At least that's how it's being messaged. So, but those are really the 3 key reasons why tariffs will be implemented. And as I mentioned, tune into the hour-long discussion around that. But when we think about it from an investment standpoint, because that's typically where I spend a lot of my time, and I think what draws a lot of questions from clients and people out in the market is, what does this actually mean for markets? And we've seen a lot, as I know you guys are very familiar with, we've seen a lot of increased volatility over the last few weeks since those announcements have come out. And one thing that I am reminded of just from kind of going through this is drawdowns in markets like we've seen over the last few weeks. These are not something that's new. We looked back at drawdowns going from all the way back to 1950 for the S&P 500 index. And one of the main things that I saw were there were 22 different drawdowns of over 15% or more that markets have experienced. These drawdowns, I think as we think back to the question of like, is this time different? That's kind of what keeps popping up. And how I think about it is, the answer is yes, it is different. This is being driven by tariffs, by the kind of widespread announcements and uncertainty around tariffs, potentially even more impactful. if you look at all of those 22 drawdowns of 15% or more, the cause is always different. The tech bubble in 1999 to early 2000s, the global financial crisis in 2008, the coronavirus sell-off in 2020 when it was a 1 month sell-off of 34% in US markets that took 1 month when the world and the economy was shutting down. No one saw that coming, but what we did see coming, and I think what we can say with pretty much with a good bit of confidence, is that we don't know when the next drawdown will come, but what we do know as investors is that it is going to come, and there's things that we can do and that we do to help provide value in these moments.
Yeah, I mean, you mentioned 22 times since 1950. I kind of do some basic math. That feels like every 3 or 4 years, you kind of anticipate one of these moments coming to pass. And like you mentioned, it always is a little bit different, but there's always some similarities. Pat, I would love your take on is this time different?
Well, there's the famous saying is that's the most dangerous words in investing, because it's kind of kind of your reasoning on why you would get out of the market is because if this time's different, why would I want to be invested? So I think the answer, like Justin said, is always yes. It's always a little different. The market's reaction to it is what really stays consistent over time. When you think about just in general, the pricing of the stock market, the pricing of individual stocks. In a free market, you have buyers and sellers. And what their goal is when they're trying to price a stock is trying to figure out what the right value is of that stock based on what's going to happen in the future. So as tariffs got announced, we obviously found out that that would probably impact earnings of companies. Like Justin said, they're going to have to now pay a portion of their, of what they import in a tax. So that's going to have an impact on future earnings. But we don't know if the tariffs are going to go into place, whether they're going to be revoked, whether they could be expanded even further. So I think that all that stuff is trying to be digested by the market. But again, if you look at earnings today, they're pretty good in the markets. They haven't been really impacted that much. The tariffs really just became in place, but price stock dropped over 15%. So I think what that's telling us is that the things are going to get, at least the market is predicting that things are going to get a little bit worse in the economy. And so the market's reaction is that it's going to lower prices accordingly. So I think, whether you go back to COVID, whether you go back to the financial crisis, whether you go back to the tech boom and bust that Justin was mentioning, they all kind of were different reasons, but the market sold off because it was repricing securities with what's kind of known at the time. So I think the one area that might be it's not new, but it's a little different than the last few episodes as well and this one, I know we won't dive into this because it's a little bit of a touchy subject, but this is a little bit different in the sense that it's involving politics as well. And it's involving ideologies. And obviously there's very, very strongly held views on both sides. So I think it's one, I would just say, warning for our audience listening today, our clients, is how dangerous it is to let politics drive your investment making decisions. And I think this is a great example of that. The markets are going to react and price things as what they believe will happen in the future, not because of a political ideology. So if you are making investment decisions based on who's in office, it usually doesn't turn out very well.
Yeah, the market volatility, which volatility just means on any given day, the market could go up a lot or go down a lot. We don't really know which direction it'll go. One thing that is pretty consistent with markets, it's very tough to tell directionally, hey, is this the bottom? Can it keep going? Is this the turnaround point? But what you can tell is volatility tends to beget more volatility. So that is pretty consistent. And to your point, Pat, as investors, our risks are increasing. There are a few businesses that this is actually pretty good for. Liquidity providers are one of them. So I was reading an article, the 3 largest banks, their equity trading desks, had their most profitable quarter. And that was just halfway through tariffs coming into fruition. So we're seeing implementation costs escalate. And this is causing people to tune in and look at newspapers and read articles. And that's a different form of, it's entertainment in some sense, it's education in another sense. I don't think when I read the Wall Street Journal, they're explicitly saying, do this, don't do this with your money, but it's heavily implied. that there's a way you can react to some of this stuff. And I think you said it really, really well, which is stock prices, what they do, they care about future earnings and risk. And if future earnings are expected to go down and risk goes up, meaning uncertainty, that's going to lower your stock returns today. It's going to lower your stock prices, but they're reset given those are coming into play. So now forward looking, we should have similar expected returns that we had before. It's pretty painful to get there.
I'll make one comment on that because I think it's really important to understand is this news is coming out. It's obviously negative news. The markets are are being impacted. I think there's a general tendency to think that, well, things are going to get worse. Things are bad. They're going to get worse, and they may. And so therefore, maybe I should sit out on the sidelines. I should lower my equity exposure a bit to get through this period. I think it's important to recognize is the market is already anticipating that things are going to get worse. That's already been shown through stock prices. So what you have to know to be able to profit from that kind of information is you have to know that it's going to get worse than expected. And that's a really difficult thing to know because nobody really knows what that looks like. The market's probably doing the best job out of anybody with buyers and sellers saying, we're pricing this stock at a level where we think there's some equilibrium here. There's buyers and sellers both trading it. It seems like a fair value. Now, if information comes out that we weren't expecting, it could go down even more, or it could go up. I mean, I think what we found was the exact opposite happened a week or so after the tariffs were announced, where stock prices went up 10% one day because information came out that was different or wasn't expected. And so again, that's what it makes it so hard to try to time these markets. And I think to your point, Marcus, the idea of who's making money, banks providing liquidity, well, who are they taking the money from? And where are they making this money? Well, it's coming from people that are trading. So if you're trying to buy and sell, the cost to do that goes up, and it might be in small increments, but you're most likely losing out in times of uncertainty because you're paying more to buy or sell. So just something else to keep in mind if you're making changes in the portfolio, especially if you're making multiple changes in the portfolio.
Yeah, it's Justin and I were talking about this before. It's pretty interesting where the stock market, it does tend to bottom before the hard economic data bottoms. So if you look at unemployment rates, GDP, et cetera, the stock market's forward looking and all those economic indicators are backwards looking. Justin, I would be interested. Obviously, last year was a really good year in the market. So if we put it in perspective of this year versus last year, is this even that significant, kind of what we're talking about? Don't know if you have that off the top of your head.
Well, I guess it depends at what point you're checking where the market is at. But I think what I like to think about is, yes, we, experienced the drawdown a little bit over 15% at its worst, as Pat mentioned. It's gotten a lot better since then, or it's gotten better since then. There's still some room to go. But we've also come off of some really strong years for markets. 2023, 2024, both really, really strong years. So while you may see, depending on what your overall asset allocation looks like, your drawdown will look a bit different. When we say the 15% number, that's only if you're large cap US equity stocks, which we believe in a much more diversified approach to doing that. So it's not necessarily going to look like that, but I think your personal situation will differ. And more importantly, it's coming off of a few really strong years for the market. So sort of where you're at from a total balance perspective, if there's no other changes going on, it's probably not that different than where you were maybe a year ago at this time.
I think one thing that I would maybe touch on there too is for years and years, the best performing asset class, at least over rolling 5-10 years, has been these large US companies. They've really just dominated the performance for most clients that have stayed the course and said, maybe I won't, instead of putting all my eggs in that basket, I'm going to stay diversified. I'm going to own some international stocks. I'm going to own some bonds. I might own some other asset classes that aren't really correlated to those. This period is exactly the types of markets that that you benefit from having diversification in the portfolio. Most of those other asset classes, at least for the first 3 months of the year, while US markets were down, they were all positive, and they've even held up pretty well. Some of them have come down a bit, but they've held up much better than US large cap stocks. So it's just an example of staying the course through a diversified portfolio. There's always something to complain about when you're diversified. Right now, it's U.S. stocks, large U.S. stocks. Over the past few years, it's been international, but they've flipped and they've now been the best. So it's hard to time it. It's hard to know what's going to be the best performer. I mean, if you listen to the news, I would say over the first month or 2 or 3 months of the year, and they were talking about tariffs, I think most people would say it sounds like they're really punishing other countries, companies that are based in other countries. That seemed to be the narrative. But in fact, there's just massive difference in performance of international stocks being positive and U.S. stocks being negative during that stretch. So again, it makes it tough to try to time this stuff.
Yeah, there's two ways to look at diversification. It means you're always having to say sorry because something's down, or you're never having to say sorry because you're getting kind of the average. Something's down, but something's up a little bit more. And that kind of leads us into this question of, is it different? History rhymes. It doesn't repeat. So there's some similarities, but there's definitely some nuances. But then it's, how should we be reacting? And I kind of think there's two components. There's the strategic component, which is what big changes should you or should you not make? And then there's kind of the tactical component as well, which is, hey, how do you think about making any of those changes? So if we just focus on that strategic component, I think you kind of touched on something which is fantastic. Is your portfolio built for both the good times and the bad times, right? And if your portfolio is built for both of those time periods, then yeah, you can focus on implementing your plan, not changing your plan. If your portfolio is highly concentrated, really just focused on the good state of the world, hey, you might want to think about, this is as good of a time as any to add in some diversification. And things that we know with clients is everybody probably has some opportunity to get their portfolio in a slightly better place, whether that's legacy positions they didn't rebalance for tax reasons. There's just a ton of nuances and legacy things that provide opportunities to kind of implement your
maybe I touch briefly on the strategic side of things. I think one of the things that we've been communicating to clients, and hopefully listeners, if they're not clients, have something similar in place, which is that we built your plan for times like this. We don't build plans for the good times. Everybody's fine when markets are going up 15% a year. What we're building plans for is what happens when things go bad, and not just markets being down, but also higher inflation too. That's something we haven't talked about, but I think the chance that there could be higher inflation has gone up as well. When you have tariffs, typically some portion of that tariff shows up in higher prices of goods. And so as a retiree, when I go to the grocery store or I go out to dinner or I go to the movies or whatever it is, I want to travel. If you're going to see higher prices, we want to make sure plans have built that in, that's a possibility in a plan. So I would just say that that's really important, is that you have a financial plan that contemplates different scenarios that could happen, bad scenarios that could happen around inflation and investment declines. And I think the other part of it, Marcus, you alluded to this too, is really revisiting strategically the risk that's required in your portfolio and the risks that you're willing to take in the portfolio. So if you are found that you're having a hard time sleeping at night, you have a hard time, living with this portfolio, if you will. Nobody likes it. Let me be clear. Nobody likes downturns, but there are times where people say, I understand it's a part of investing and I'll just ride it out. And I think a lot of people have that mentality. But if you get to the point where you're looking at your statement constantly, you're looking online, you say, I can't take this anymore. You may not have had the right risk tolerance to begin with. You may have taken too much risk to begin with. And I think it's an opportunity for you to revisit that. It also has to marry up, though, with your financial plan, which is your risk requirement, which is how much risk do you need to take to be able to accomplish all of the goals that you've set forth. And the hope is that those two numbers can live kind of harmoniously together. If there's one that is, hey, you need a very high return to be able to achieve your goals, but you have a very low tolerance for risk, then that oftentimes needs to be discussed with the advisor. You need to look at tweaking your financial plan, and there's lots of different ways and levers, and we can talk about that in another episode. But I think that's at a strategic standpoint. It's what's my asset allocation? because that drives my risk. Am I comfortable with it? And do I have a financial plan in place to be able to weather this, to be able to look at these types of scenarios and make sure I can live with it?
Yeah, and there's definitely people that have reached out as well that have said, hey, I'm not comfortable, but I view this as an opportunity. And this is why we kind of know markets are working, because we see it firsthand. And that's an opportunity to say, hey, maybe we weren't taking the right amount of risk on the front end in the opposite direction. We built up cash, which means it wasn't being invested. And now we're deploying it. When we look at the research around, hey, is it better to dollar cost average or invest kind of when you have the cash? You expect markets to go up. So the math tends to work out every single time. Hey, you want to actually invest when you can. So that's an opportunity to do the opposite. It just depends on your stage of life. And this is a great time to sit back and think about it. How do you feel? Do you feel good? Do you feel like you could take a little more risk? Do you feel like maybe it's a little too uncomfortable? And probably not act, but just think about what that means going forwards. Because I know you and I talk about this all the time, Pat. You don't want to be flipping back and forth between, hey, when times are bad, you reduce your risk. And then when times are good, you say, hey, I actually want to own more stocks. That's the opposite kind of the approach that you want to be taking.
Yeah, the term I tend to hear is lighten up on equities, and that's always a scary term that I hear, because it basically means I want to time this market. I want to get out because I'm scared. And it's I guess it's one of those things where if you've had that notion, or you maybe better, you've acted on that notion of reducing the equities in your portfolio, I would say there's a decent chance you don't have the right tolerance, you don't have the right correct asset allocation to start with, because you are uncomfortable with this risk coming down. So, and causing the portfolio to come down, and that's causing you to make changes in the portfolio. So, because if there's nothing else I can think of that really destroys performance than bad behavioral decisions that force you to kind of sell after prices have gone down and then repurchase at higher prices in the future. And, that's one of the biggest investment mistakes that people make.
Yeah.
You mind if I jump in there?
Of course.
I tend to agree there, Pat. And I think a lot of times when we do get those questions, it's not before anything happens in the market. It's once you see volatility increase, you see a large drawdown, a few big days where the market is down. That's when people might have that urge to be like, wow, like this is scary. Like, I don't like seeing my portfolio go down in value, trying to go into timing the market. But I think two things there. One, when you choose to leave the market, whether that's completely or just lowering your allocation, you're picking when to leave. So you're trying to time that, and you've probably already endured some of the bad days that were part of it. But you also have to pick when you're going to go back into the market. And when we look at some of these periods of volatility, going back to 1950, every single day's return for the US stock market. I mentioned some of those periods earlier, but if you think about the 10 best and the 10 worst days that we've seen in the market since 1950, most of those days are clustered together. So like back in 2020, when the market drew down over 1 month for COVID, you had 3 of the best days that the market has ever had and 3 of the worst days that the market has ever had. So imagine you're an investor who, after a 8 to 10% drawdown in one day, certainly that is very scary to see. But imagine you make a change right after that, and then you miss the next day when it bounces back, 5 to 10%. So that's a risk that's there. And I also think just a more general, because you never know how long a drawdown might be or when the recovery will happen. I think we saw it again recently be kind of back to back, where you would get a bad day then a good day. But you never know kind of what that stretch will look like. But I think if you're waiting essentially for things to calm down, for there to not be volatility or news or negative headlines in the market, it's going to be hard to find a time when that exists. It could quiet down a little bit, but part of investing in markets is that there is risk and there is volatility associated with that. That's why you get paid to be an investor in these companies. So I think that's an important thing when I think about just from a personal standpoint. Like, if you were to leave, not only could you miss those initial days, but you could find yourself sitting on the sidelines for months and months at a time before you enter back in. And by then you've certainly missed a lot of that sort of bounce back that is there. And the last thing, just to add one more data point there, when we did look at those 22 drawdowns that I mentioned earlier that were at least 15% or more, obviously no one knows when you're in a drawdown what the bottom will be. But if you just said the market dropped 15%, $100 or however many dollars at that point in time, just 6 months later, the market on average was up 8%. And just a year later, the market was up 18.5%. So it could have continued to go down for months after that. But history shows us in these drawdowns that if you're able to hold on for a little bit of time, typically that has rewarded investors who have used that as an opportunity to lean in versus pull their money out.
One thing I'd even add to that, I think the work you did on this was really, really great. You mentioned 22 times, I believe.
Mm-hmm.
Only 3 of those a year later, if you were to say, I'm going to invest when the market drops 15%, only 3 of those times was the market negative. So, what it tells you is it can continue to go down. It can go down 15% and keep going. But the odds is that it will be higher a year later. At least history tells us that. So I think there's been some other work you've done on this. I think it's important. It all kind of points to the same thing. One of the things that measures volatility is this term called the VIX, which is this volatility index, if you will. When the VIX hits its highest level, the future returns are the highest. So again, if you take this approach of when things look bad, I'm going to get out and I'm going to wait for it to look better, you are most likely getting out at low prices and you are missing the run up that prices will when they come back. You did a similar kind of research on another metric of unemployment. So unemployment goes up. Gosh, things are gotten bad. The economy looks bad. We should get out of the markets. When the unemployment is the highest, future returns are the highest. Again, because these data points are backward looking, they're telling you what happened in the past. You've already had a 15% drawdown. You've already had people lose their jobs. The market is forward looking though. So it's looking into the future and it is looking past that stuff because that's already happened. And it's trying to figure out what's going to happen 18 months from now. And I'm going to put that into the stock price. So again, it's just this danger of looking and listening to bad news and assuming that is going to reflect in stock prices. It already has. That's the problem.
Mm-hmm.
If it's on the news, everybody knows about it. That's already been put into stock prices. So it's just a warning for people if you're basing decisions based on CNBC or CNN or any other news source that you're looking at, it's most likely already baked into stock prices.
Yeah. And what we're talking about, again, is these big strategic decisions. And essentially what we're saying is uncertainty is increasing. That kind of amplifies the magnitude of any decision you're going to make. And what we've seen over history, sit tight, really think through those decisions. But at the same time, it doesn't mean that you're not making any choices given market volatility. It's just, hey, have a system in place to make those decisions based upon evidence, not reactionary. And so, Justin, maybe I would ask you, like, your team is the one going in and trading in markets all the time. What are you thinking about doing in a time like this? What is Greenspring doing?
Yeah, thanks. Definitely a good lead in, Marcus. I think my team has been very busy over the last month. Certainly, markets moving just has a lot more that comes with it from monitoring portfolios. So just to level set, you led into this, but my team on a daily basis, along with the advisors, are monitoring portfolios, ensuring that they remain kind of in line with the investment plan. When there needs to be trades, our team is helping to facilitate that. So I think one metric that we looked at leading into this was just our volume of trading that our team was doing. And what we saw was essentially once the Liberation Day announcements took place, we saw that our trading volume doubled essentially. And why that is I kind of boil it down to 2 main factors. One, you have situations where someone has a long time horizon, they either have excess cash, or because we do have diversification built into our portfolios and we have other asset classes that were either up or more so flat at that time, we could rebalance, essentially buying equities at a more discounted price. So then when you look, as we said earlier, 6 to a year plus out, you sort of benefit from buying at a more discounted price. So that's like one set of what we're doing is rebalancing to take advantage of the drawdown essentially. And two is tax loss harvesting. So what tax loss harvesting is essentially is when you do have any investment that is down for a certain period of time, if you sell it, you can realize losses for that investment. So I would say that we have a very sophisticated process around tax loss harvesting because it's something you have to do very thoughtfully and intentionally. Pat mentioned earlier, trading volume increase, or maybe it was you, Marcus, but trading volume is increasing at different places that can have to deal with spread. So a lot of what our team is doing is making sure that we're getting good spreads on the trades that we're submitting, making sure that we're getting good prices for our clients. But a big component of tax loss harvesting is essentially saying, okay, great. If you're going to sell something to realize losses, where are you going to go? You have to buy something else because otherwise you're getting the same problem. You sell at a loss and then you sit in cash and you miss when the market rebounds. So what we do is at an investment committee level, we have funds that we monitor every day, every week, every month, where we're meeting with managers, we're talking internally, we're tracking them to ensure that they are sort of our primary funds that we use in our plans. And if you're a client, you're invested in all of these. When we do have these opportunities where the market draws down, we're not selling to react to the market and to have sort of that type of behavior. What we're doing is saying, okay, this is an opportunity for us to look at our clients' portfolios, to realize losses, and then to swap them in to a very comparable fund that in the short term we have very high confidence that it will track very closely to what they moved out of. So essentially you can sell fund X to realize a certain amount of losses and buy fund Y or Z and get a very similar experience for 30 days or so. And then after 30, 31 days can either stay in that fund or flip back into the original fund. We've been able to harvest these losses, which is a huge tax savings for clients, $1.5 million. And we've been able to do that. That's like another big component, I would say, of what we're doing behind the scenes, really on a day in, day out basis. But when you have these periods of increased volatility, it presents a larger opportunity to do that.
And then I think also for the audience to think about is a few others that I would just throw out there. In every crisis, there's an opportunity type of thing. And so when I think about that, there's a few. One is if you have outstanding debt, we have not seen rates really fall that much, but there is a potential that if we go through some tough times that you could see rates fall. You should be monitoring let's just say your mortgage, what rate you're paying. If you bought a house in the last couple of years, your mortgage rate could be 6, 7, 8% even. If rates fall, then that's something that you should be looking at is this a good time to refinance my loans and just lock in lower rates so I have lower debt payments moving forward? I think another couple things to think about is when asset prices fall, there's a couple items. One being, if you were planning to do Roth conversions, for example, in a given year, this may not be a bad time to start thinking about that, because what do I really want to do once I convert some of my money from an IRA to a Roth IRA? Well, what I really want is once it gets into the Roth IRA, I want it to really go up in value because all that growth will be tax-free. And so when you think about the data that Justin was sharing earlier, that on average, after the market drops 15%, on average, a year later, prices are up 18%. Now, there's no guarantees and there's a wide range of outcomes, but that's the average. And we kind of deal in uncertainty and probabilities when we invest. But I would say now is probably a better time to convert your IRA to a Roth IRA or some portion of it than it was a month ago. And then the last thing in a similar vein is if you are gifting money to your kids, if you are gifting money to family members, oftentimes you want to get it out of your estate as more of a tax planning strategy and not have to use a lot of your exemption when you do that, your estate exemption. This is maybe a good time. It's, hey, I was going to give them 100 shares of, you name the stock, Microsoft. Well, now I can use less of my exemption of how much I'm allowed to give to them because it's lower, it's priced lower. So I can still give them 100 shares. Maybe I can give them 150 shares now or 125 shares because the price has gone down. So there's opportunities. And sometimes what I would say is if you're not working with an advisor and it's just stuff that you have to get to, these opportunities don't last forever. There's times, Justin probably used the most extreme example of COVID, where we had a very, very short window to do things like tax loss harvests, Roth conversions, those that bounce straight up. There's other periods like the tech bubble and boom and bust, where it was 3 years of downward markets. So you don't really know when the bottom is going to hit, and you also don't know when it's going to recover. Typically, when it does recover, it moves pretty quickly. So if you're waiting, kind of, I'll get to it eventually. I'll eventually do some tax loss harvesting. I would just caution you that these things can move fairly quickly. And if it's a good time to do it, it's probably worth considering doing it now versus waiting to the future. Every day you wait, again, going back to that data, if the market's going to be higher on average a year from now, if I keep waiting, the more likely scenario is those losses won't be there to harvest. That Roth conversion is going to be a less of a compelling argument to do. So just something to consider as you're thinking about these items.
Yeah, and what you're describing there is something we talked about earlier, which is you have to build a plan in advance. Your plan has to be something that works in both states of the world, the good state of the world, the bad state of the world. When the world is difficult, you kind of have to have these rules and your ideas on what you could do built in advance so you're prepared to do it. And then what Justin was talking about is you have to be really hyper-focused on actually getting it done. And it's hard to do all of those things all at one time, but tax loss harvesting is one of those things where think about the complexity around going from a mutual fund to an ETF. If you're operating through a retail investment platform, you're selling a mutual fund at 4 p.m. that day. Most investors are probably not going to be able to work it same day. So then you got to wait overnight. And it's the most volatile time period that we're talking in, which means you could see swings of 5-6%. So if you're trying to harvest something that might yield you 1% of your portfolio value, but you're risking 5%, you just have to be super, super diligent that you're not pushing these ideas too far without the right rules and processes to do it. Because as we mentioned, the cost of executing these trades kind of goes up in times of volatility. And so you have to be thinking about the process and then also how you trade. And I think, Justin, that's what you were alluding to, which is now that the world's shifting towards ETFs, which provide a lot of tax benefits, we use mutual funds that provide similar tax benefits as well in terms of capital gain deferral. But you're now tasked with trading throughout the day. You don't get the NAV, you don't get the asset value at the end of the day. You're risking intraday pricing, premiums, discounts, bid-ask spreads. These are things that you have to be conscious of because you're going to go out there and implement in why we're having this conversation, because markets are volatile.
Yeah, those are great points. And I think the one thing that I maybe alluded to but could add on there as well in the tax loss harvesting is it's not something that, the opportunity presents itself and then we say, okay, great, like what can we switch into? What's a good fund? There is months and tons of work and research that's going into it behind the scenes so that when those opportunities do present themselves quickly and often with not a large amount of time for us to act in, we're ready to go. We know what to switch into. And with that, you need to make sure when you are tax loss harvesting as well, that you have a very comparable fund, at least for how it will perform in the short term. You want to be careful not to sell something that, is a broad US equity fund and buy an emerging market fund, because anything that you do, if there's a huge difference in the type of fund you're going to miss, you're not just tax loss harvesting, you're making a bet essentially on what's going to happen. And there's tons and tons of research that is out there that shows that trying to predict what will happen is a flawed strategy, and it's very, very difficult to find success in doing that. So you need to make sure when you do switch, you're going to have a similar short-term experience, which is why it's important to track this over time to really know and understand the funds and the ETFs that you're using and that they're going to behave how you expect them to in these circumstances.
Yeah, the last couple things I'll mention on just where we're at today is that, volatility is a feature of markets. It's not a bug. If there was no volatility in markets, there would not be excess returns. It's this thing that we have to accept as as being investors. So we know over time, the markets are going to reward us. Over time, it's been the last 100 years or so, it's been about a 10% per year return. But with that, we have to be willing to accept periods like we're going through now. Like Marcus said in the very beginning, once every 3 or 4 years on average, this is kind of what markets do. And that's just part of investing and part of the things that we have to be able to accept. So I think the nice thing is that 10% a year includes periods like this that we go through every 3 or 4 years. So it's not like I have to avoid these periods to be able to get to 10%. We can get to 10%, if that's our long-term return, by just buying and holding through these periods. And I think we've talked about, some tweaks that you can make to maybe improve things from a tax or implementation standpoint. But, that's the thing that we don't have to time the markets to be successful. We don't have to get in and out. The market does reward long-term investors. And these are the times where, as someone who once kind of was a mentor of mine for a long time ago said, in bear markets, rightful capital returns to its rightful owners. This is kind of the periods like that where, those that are long-term investors, they get to the rewards of kind of seeing their capital grow. Those that make rash decisions typically don't. And I think it's important for people to remember that.
That's a great summary of the discussion. I don't have anything to add on to that. Justin, do you have any closing thoughts?
No, I don't. Nothing additional from my end. Thanks for having me.
Wonderful. Well, thank you both for joining and just talking about, is this time different? And yes and no is the answer. As with everything in markets, it kind of depends. There's a lot of connection, but there's a lot of differences as well. So thank you. We'll get back to work.